Consumer prices slowed in the month of August. The Labor Department's Consumer Price Index was up just 0.1% last month after a much bigger rise in July. It's a big drop in the cost of gasoline that is to blame. The Fed has worried lately that inflation is rising too slowly. It was one of the reasons it cut interest rates in July. Joining us to talk about this and a lot more, Barry Bannister, Stifel's head of institutional equity strategy. He joins us from Baltimore. Thank you for being here. Julie and I were discussing Stifel's latest note about where we're headed. And I realize you're looking at possibilities. I'll jump to conclusions because one of the things that stands out is the real possibility of recession by May of 2020 in the note. So how do we as investors prepare for that? What are you doing? What should we be doing?
Yeah, when you look at the 50-day moving average of the 10-year, 3-month yield curve, it's given no false signals in 50 years. You can't look at the daily or the weekly. You have to look at a smoothed version of the yield curve. And so a 50-day moving average is good enough. When we look at that and the lead time to recessions, that's about a mean and median of 10.5 months. And then, of course, the market has led all post-war recessions by an average of about 5.5 months. So the risk would probably be manifest around December of this year. Recall last December we had recession scares as well. So that's what we'll be watching for at this point in time.
And so how do you set up for that then? Or is it too early at this point to begin to do so?
Yeah, the bounce in the market that we've seen recently, as well as the bounce in the 10-year yield, is probably just the typical 6-month lag to Chinese stimulus that occurred in the first quarter of 2019. In the last 5 years, China poured on the bank and non-bank lending, as well as the fiscal stimulus at the local government level into the first quarter and then trailed off the rest of the year. So with a bounce here in the third quarter in activity, such as we saw with some hope on ISMs, the PMIs, the Purchasing Manager Indices, that may fade. And of course, the 10-year yield would fade with it as we go into the end of the year. So I'm still fairly cautious. If this is a multi-year reversal, we have time to join it later. But we have been in the defensive sectors, REITs, utilities, staples, telecom, for the last year, and would continue that despite the bounce here.
Yeah, Barry, so making a more bullish case for your investors, what would be the underpinnings of that? In other words, why have equity exposure to the extent that you guys are at all at this point?
Yeah. When you think about what's been driving the market, it's really just the 3 put options, okay? The market perceives there's a put option on Trump that he wants to get reelected, so he'll cut some sort of a weak deal with China that kicks the can into the post-2020 election. There's a put option on China that communists just can't do recessions. That's part of their social compact. So they'll do whatever it takes on the stimulus side to prevent a Chinese recession. And the problem with put options is that the other side, the counterparty, can always default. In other words, the put option on the Fed as well is that they have, they'll do whatever it takes to prevent a recession that would threaten their independence through legislation as a motive. Now, the problem with that is simple. The other side of the trade of the counterparty of the put options may have gone too far already. They may have locked in recessions that they can't prevent. And when that reality sets in, then the market would take a dip. We'll know that by the end of the year. Right now, we're just in a trading range based on a very full valuation multiple on still fairly weak earnings growth.
Barry, let me read from the note because I loved what you wrote here. Rate signal a bear market and Fed hesitations risk a repeat of Custer's last stand at Little Bighorn. Add to that what Secretary Mnuchin said today, with the Treasury looking at the potential for a 50-year bond very seriously next year. What do we do?
Well, it's in many things in life, when somebody's offering to sell something, then it's caveat emptor. Maybe the buyer should beware. If the government wants to lock in its low current interest rates for 50 years, then maybe that's just something we should be leery of if we're going to take a 50-year look at that kind of duration risk. And insofar, and we have a lot of retirement liabilities coming up mid-century with the median baby boomer now around 61 years old and only getting older and in many cases less healthy, and the medical costs for that paid by the government are going to skyrocket. So when I look at a 50-year bond, I'm not terribly interested in it, but I understand the motivation.
Barry Bannister, head
Now,
of
the other question, the other question is, what do we do?
Keep going, Barry.
Go ahead. Well, the other question is on the Custer's last stand. I think what I was trying to get across there is the Fed is in a very tough position. I mean, on the one side, they've got the president calls them the enemy of the people, and on the other side, they don't have any friends on that side of the aisle either. These are folks who want MMT, modern monetary theory, to treat money as a public good, to legislatively control the Fed, to monetize whatever deficits Congress dreams up it wishes to spend during any future recession. So when you think of the Fed's position, this is the wrong time to make a last stand, and they risk a wipeout like Little Bighorn if they do. They cannot afford to risk a recession. And so my point on that was they should be cutting more aggressively than just the 2/4 points that we've done this year. They should be doing a lot more than that if they want to prevent a recession.
Sorry I had to interrupt you, but Barry Bannister, head of institutional equity strategy at Stifel, thank you.